Let's begin with high yield. The first quarter was a rocky one for high yield, but so far this month, in April, spreads are tightening, the yield to worst is dropping, and returns are on the rise. Is that what is supposed to happen in a rising rate environment in the latter innings of a credit cycle?
I think the reason that you had such a rocky first quarter is folks were looking at some of those larger themes. But when you dig in, you realize the time it's going to take for all of those things to take place, interest rate hikes to really take hold, a credit cycle that still is elongating, and companies are still showing growth. You recognize that 2018 is still probably going to be a good year for credit, and so you had in terms of credit fundamentals.
What about credit performance?
Well, that's the question is
where can you make money?
Well, those are two separate questions. So, there's a lot of exogenous factors that would go into performance, political and otherwise. The question is, will the Fed be deliberate in their rate hikes, or will they, inflation so far has stayed down. If the Fed gets a little nervous and hikes rates quicker, that would obviously affect performance as it did in the first quarter. But if they're deliberate in their rate hikes, it's interesting to me. When we first met, I was trying to recall when that was. It was a while ago?
Quite a while ago now,
yes. We looked at we first met would we be hyperventilating about a 2.8, 2.85% 10-year Treasury? We would have said, hallelujah, those rates are low. Now it's 2.8%, and oh my gosh, the Fed could hike to 3%. It's still a very accommodative, policy for credit. And then in terms of whether investors can find opportunities, it's always our job to find opportunities.
Well, in theory, right, fixed rate instruments are supposed to be where the risk lies in a rising rate environment. Are you getting paid today, or is your average investor getting paid for the risk taken in high yield, or for that matter, investment grade?
Well, by the way, as you know, it would be more pronounced in investment grade.
Of course.
Because you have less cushion on your yield. And if you look at a typical math equation on liquidity premium and default loss, there's really no defaults baked into this year. Most folks project
price for perfection.
1%. And it's somewhat secular, whether it's in retail or otherwise. And even then, you can find opportunity. We, in the high yield side, we bought a bunch of Neiman Marcus paper in the 50s, and now it's in the 60s. So, so I think there's bigger questions in retail as to consumer trends than there might be in valuation. So spreads are tight versus historical norms, and you need to look at that.
Most investors aren't doing the work required to give you the confidence that you need to buy Neiman Marcus paper at 50 cents on the dollar. What about the people who are just blindly putting money into credit ETFs?
Well, whenever I comment on things like that, it sounds like I'm being overly competitive, which I am overly competitive.
Just be honest.
But, well, the ETFs, first of all, are not really, for credit, not like equities, are not really a good exemplar of the benchmark. And so, I haven't tracked this year, but historically, 80% of managers beat the ETF benchmarks in credit versus almost vice versa in equities. And so I typically, whenever I was in a meeting in Minneapolis on Friday morning, a very large global insurance company, a very smart group of fixed income people, and their main focus is to make sure for things we might be talking to them about that we don't end up as a vintage investor. So if you just dive into the market at any particular time and buy the market whenever that market is, unless it's at a trough, you're going to have a unfortunate ending.
I guess what I'm trying to get a sense of, Mark, is what advice do you have for the tourists, the unseasoned investors who keep pumping money into both illiquid and liquid credit strategies?
So, first of all, they're doing some things that are intelligent, right? So one of the things that happened in the first quarter, besides interest rate moves, is there were money coming out of high yield and money going into widely syndicated bank loans, which have a floating rate component, and a LIBOR floor now that's high enough that you can get some semblance of an absolute return. So on a large scale basis, that was the right trade that quarter. As spreads between new issue bank loans and new issue high yield get to about 150 basis points, probably better off going into high yield. But right now it's still tighter than that, so the trade is still more probably oriented towards floating rate debt. But all the markets, we talked about this on the way in, all the markets are somewhat priced for perfection. Valuations are high everywhere. Private equity prices,
real
loans,
estate,
artwork. I could mention
in your world,
team, sports teams.
What's frothiest?
There's a lot of froth. I think venture capital. It's not something that I'm expert in, but I'm on a board with Charlie Munger, and he was talking about some of these things. Warren's partner, and I said, well, I pretty much asked him that question. First thing that came to mind for him, he's a lot smarter than I am, is venture capital.
What about in credit then?
Well, we look at credit, as a kind of side by side with that, technology multiples, people are willing to lend to technology companies at higher multiples, sometimes upwards of 10 times than we're typically comfortable with at Crescent. So you're seeing that. But that doesn't mean there are not pockets of opportunity in lending to tech companies, because those often have the best growth characteristics.
So conversely, where is there value? Is there anywhere in credit where there's value?
There's value in looking at complex situations. There's value in understanding pro formas in which you can absorb and which you should discard. And I think that that's best left to, and there's a lot of very good firms out there, obviously, that's best left to professional investment firms and not just buying the market. Probably difficult to buy the market at, generically at this spread right now.
If you were to buy the market at this spread right now, do you think you are inevitably going to lose money?
Probably.
Over what period of time? How long does it take for those losses to crystallize?
Well, that's, this is the question. I know there's been a lot of focus lately on the excess of corporate debt in the market. First of all, there's a huge amount of liquidity globally. And if folks are talking about a 2020 recession, which they're talking about, for investors, that's a lifetime between now and 2020. So what we've tried to do at Crescent is just grind it out year after year. We're looking to grind it out this year. We're pretty optimistic about this year, notwithstanding some of the challenges.
Where are you most comfortable or confident deploying capital?
Well, we like private better than public. I don't want to talk against our public strategies because we have a greater measure of control. We often originate the transactions, we structure the transactions. Most of our private deals have better structure than even syndicated bank loans.
There's so much money in private credit now. Isn't it getting too competitive?
It is getting competitive. From our standpoint, we've been investing in private credit for 27 years. So we have a lead time and depth of relationships that allows us to, we feel we see pretty much everything out there and can pick and choose what we like.